describe selected market anomalies. So far, we've discussed how research has shown that markets are generally efficient. Research has also shown that there are a number of inefficiencies or anomalies that result in the mispricing of securities. These anomalies occur outside of what would normally be expected by currently relevant information known in the market. To be considered a market anomaly, the inefficiency must be consistent over reasonably long periods of time. That is to say, if a suspected anomaly is discovered, it should hold over long time horizons and not be simply a result of data mining a small time period sample. Data mining, or data snooping, is the process of fitting data into a hypothesis. This is the opposite of good research practice, which says a hypothesis should be developed first, and then data confirms or rejects that hypothesis. Anomalies are categorized into three major groupings based on the research method used to identify the anomaly: time series anomalies, cross-sectional anomalies, and other anomalies. Let's take a closer look at each. Within time series anomalies, there are two major types: calendar anomalies and momentum and overreaction anomalies. One of the most well-known calendar anomalies is called the January effect. This effect states that stocks, especially small-cap stocks, tend to rise in January, especially in the first 5 days of the months. A number of reasons have been attributed to this effect, including tax loss selling in December, and then the repurchasing of securities in January, creating a rising market. Another reason suggests that portfolio managers are window dressing their portfolios. Since managers must report their holdings as of December 31st, they may look to sell their unprofitable positions so they do not have to show them on their books to their investors. They can then repurchase the smaller, riskier securities in January to try and gain higher returns. Other calendar anomalies have also been found, although these effects have been disproven through further statistical research. These anomalies include the turn-of-the-month effect, where stocks outperform during the last trading day of the month and first 3 days of the following month. The day-of-the-week effect, where stocks trade worse on Mondays versus other days. The weekend effect, which says returns on the weekends tend to be lower than weekdays. And the holiday effect, which says returns are higher the day before holidays than on other days. Again, these anomalies, including the January effect, have generally been disproven, or proven too weak to profit from on a consistent basis. Other types of time series anomalies are momentum and overreaction anomalies. Essentially, these anomalies state that short-term share prices overreact to unexpected public information. To take advantage of this anomaly, an investor would sell stocks that have jumped in price due to unexpected good news, and buy stocks that fall in price due to unexpected bad news. This type of anomaly is contradictory to the weak form of market efficiency, because it suggests there are profitable trades based off short-term share price patterns. Research has shown that the presence of momentum is not contrary to market efficiency, because it is plausible that there are shocks to expected growth rates of companies. These shocks create a serial correlation that is rational and short-lived as stocks adjust to a shock in growth rates. The size effect results from the observation that small-cap stocks tend to outperform their large-cap peers on a risk-adjusted basis. This research was first documented in 1981. Subsequent studies, however, have failed to show this anomaly to be consistent, possibly due to investors entering the trade and reducing the potential return, and possibly due to a chance outcome used in the original study. Another cross-sectional anomaly is the value effect, which states that value stocks, such as those with low price-to-earnings and market-to-book ratios, and with high dividend yields, tend to outperform growth stocks. The value effect would contradict the semi-strong form of market efficiency, however. Fammer and French showed that when they applied their three-factor model to predict stock returns, instead of using the capital asset pricing model, the value effect disappeared. There are a variety of other anomalies that have been documented in the financial markets. One is the discount in closed-end funds. Closed-end funds are similar to mutual funds in that they own underlying assets. However, they only issue a fixed number of shares at inception. These shares often trade at a discount to the underlying assets, or net asset value. Theoretically, these shares should trade equal to the net asset value, but in reality, trade typically 4 to 10% below the net asset value. There is some evidence to suggest the discount is caused by fund fees, tax liabilities associated with unrealized gains, and liquidity problems and errors in calculating the NAV. Either way, the discounts cannot generally be exploited in any way, as the costs associated with liquidating the funds outweigh the discount. The discounts do tend to revert to zero over time. Earnings surprises, or those announcements where earnings significantly beat or miss market expectations, are also associated as a stock market anomaly. Several studies have indicated that while there should be a rapid adjustment of stock price based on the surprise, the readjustment process is not always efficient. While there is a substantial part of the adjustment that takes place on the date of the surprise, it has also been shown that part of the adjustment comes after the announcement. As a result, those companies that report the largest surprise earnings beat tend to have superior stock return performance. Likewise, those companies that have the biggest negative surprise tend to have lagging stock return performance. Another anomaly that has been documented is the outperformance of initial public offerings on their first trading day. This anomaly is thought to exist because the investment banks take on risk of selling shares to the public, and hence underprice the company to create a positive return. However, it is thought now that this anomaly may just be an artifact of the methodology due to the small size of the IPO companies and the method of equally weighting the samples. Some researchers documented that stock returns could be predicted based on prior economic information, such as dividend yields, interest rates, inflation rates, and volatility. But this finding does not result in abnormal returns due to the ever-changing relationship of stock returns and economic variables. Some researchers found in one study that stock returns were positively correlated to dividend yields in one period, but negatively correlated in another. Most anomalies are very difficult to benefit from. In fact, many are probably not violations of efficient markets at all, but rather the result of statistical methodologies used to detect anomalies. Most anomalies disappear over time, and for every positive overreaction, there tends to be an equal number of negative overreactions. On average, markets are efficient.